broadly now about the PPP lending program and others. So do you feel like those programs are reaching and getting dollars to the companies and people that need it most?
No, I don't think. I think they're falling short. The small business program, the PPP program, got off to a strong start, perhaps too strong. It was heavily oversubscribed, but there was some misuse of the funds, some publicly traded companies, some PE funds that were trying to use it inappropriately. That was a small percentage of the loans, but nonetheless, there was a backlash and a tightening of the standards. Now, a lot of legitimate small businesses, I'm afraid, are starting to become wary of using the program because of, a lot of tough rhetoric around investigations and prosecutions if you don't really need the money. So I think further clarification from Treasury would be great. I know they want small businesses to use this program, and getting that messaging and balance right, I think is very important. It is frustrating, though. I think we're about $670 billion have been authorized for the PPP program, but that really pales in comparison to the trillions that are being pumped into financial markets, and that's probably needed and helpful too. But the disparities in the resources and the quickness with which we're able to get funding into financial markets and large corporations and financial institutions, not so much in our ability to get money down in the grassroots, Main Street level. Small businesses and households continue to struggle.
Are you comparing it to the Federal Reserve? I mean, because the Fed would say, it's going to a place it's never been before. It's going to do Main Street lending. It does this time around feel like Jay Powell and the Fed are specifically paying attention to the fact that they're open to criticism, that they're helping Wall Street over Main Street and really trying to make it clear that they've got Main Street in mind this time.
Mm-hmm. Yeah, I agree with that. I think they have tried to go beyond the very, main Wall Street, big bank centric bailouts we had during the great financial crisis, and I applaud them for that. So this is not a criticism of them. It's an observation. It's simply that they are equipped. Their whole infrastructure, what they do, they pump money into financial markets. That's what they do. They're not really well equipped to provide credit to small businesses that must rely on bank credit, and medium-sized companies also that aren't really able to access the public debt markets for funding. So I think they are trying, but they're just not equipped to do it. That said, I do think that they put additional layers, especially on the Main Street lending program, that are not applying to the corporate credit facilities that the large companies are using. There's a risk retention requirement of 5% for the lenders, restrictions on buybacks, dividends, et cetera, which are appropriate. But they should perhaps be applying to the large guys, too. So there is some unevenness in terms of the hoops that borrowers need to jump through to access these facilities. And I do hope the Fed continues to think that through. I do think they're trying. I absolutely agree with that. But this is new, uncharted territory for them. And I think they're just stumbling a bit. It's just a lot easier to pump money into Wall Street.
Sheila, we talked about the banks and their dividends last time you came on, and clearly there's been no change to their policies since then. Right. From all the comments from all the CEOs who have come on our air on that topic, it's very clear they're not going to cut them of their own volition. Do you think the Fed should force them to do so?
Right. Well, I do. They have provided banks, large banks in particular, with a lot of capital relief. So they've eased their minimum capital requirements already to expand their balance sheet capacity to lend. But the way they do that is that they make the institution more fragile as they allow the bank to lower its capital base. A better way to expand lending capacity is to require that they retain capital or some combination of both. So, no, I don't think it's appropriate to provide all this relief from capital rules and still let banks pay out dividends to shareholders. And I believe several of the banks, their first quarter dividends exceeded their earnings. So they're paying out, more than 100% at a time when the economy really needs them, is relying on them, is counting on them. So I don't think that's a right thing to do for the Fed. A compromise, a middle ground I've suggested is if banks want to continue to pay dividends, pay stock dividends, don't pay cash dividends. Conserve that cash. You can pay the dividend in stock. It gives your shareholders optionality. They can hold on to the stock. If they need the cash, they can sell it in the secondary market. But with the stock dividend, you're not weakening your balance sheet the way you are with cash dividends, especially when your earnings are not supporting it.
Sheila Bair, thanks for joining us. Great to speak to you as always.